How to trade oil. Trading oil is quite simple and very similar to trading other asset classes. The key is to perform your analysis and determine whether prices have a higher probability of going up or down. Then, you simply buy or sell, and your broker takes care of the rest. Nevertheless, before placing your first oil trade, there are some mandatory steps you need to take. Step 1. Pick your instrument. To retail traders, oil trading is available via futures, options, and CFDs. Futures trading is quite expensive and comes with large standardized contracts, although there are also some mini oil futures, while options have an expiry date and are more suitable to more experienced traders. CFDs are leveraged and allow short selling, which is most likely to suit most average traders. Step 2. Open an account. Before you can start trading on crude oil, you need to have a brokerage account. You can open a live account in less than a minute with PrimeXBT and start trading right away, or choose a demo account first to practice your skills before putting real money on the line. Step 3. Get acquainted with your trading platform. PrimeXBT features an award-winning platform that caters to both beginners and seasoned traders. Play with some of the options and get familiar with the advanced charting tools before hitting the buy or sell buttons. Step 4. Analyze the market. Oil markets can be extremely volatile at times, which offers plenty of trading opportunities. However, trading without analyzing the market beforehand can be very risky and lead to unexpected losses. We'll cover the main ways of analyzing the oil market further below. Step 5. Develop a strategy and keep a trading journal. Last but not least, placing bets without a strategy is more gambling than trading. Develop your own trading strategy that suits your personal trading style and always keep a trading journal with all of your trades, including entry and exit levels, and the main reasons why you took a trade. How to make a strategy for oil trading. Developing a well-rounded strategy for oil trading is a crucial step in your journey as a commodity trader. As mentioned, there are many factors that influence the price of oil on global markets, and understanding how to analyze the market can make or break a trader. Understand the main drivers of oil prices. The essence of price changes in all financial markets can be boiled down to supply and demand dynamics. If there are more buyers than sellers, prices tend to rise, and if there are more sellers than buyers, prices tend to fall. The same applies to the crude oil market. Always follow economic calendars and read reports that cover leading economic indicators, such as retail sales, housing starts, business and consumer confidence surveys, and industrial production. When leading indicators rise and beat market expectations, there is a big chance that rising economic activity will lead to higher demand for oil, hence increasing its price. The opposite is true when leading indicators are missing market expectations and the economy faces a recession. This is when oil prices tend to fall. Since oil is denominated in US dollars, any change in the value of the currency directly impacts the pricing of the oil. That's why FOMC meetings and monetary policy decisions can also affect global oil markets. As a rule of thumb, a stronger US dollar pushes oil prices down, and a weaker US dollar sends them higher. Understand the big market players. Unlike many other markets, the oil market is mostly dominated by large oil companies and hedge funds. Oil-producing companies are constantly some of the largest companies in the world by market capitalization, so it pays to follow their footprints in the market and trade accordingly. The CFTC publishes the Commitment of Traders (COT) report each Friday. In the report, you can see any changes in positions in the oil futures markets and other commodities made by large producers, commercials, asset managers, and leveraged, smart money compared to the prior week. However, bear in mind that not all of them are participating in the market to make money. Commercials, for example, aim to hedge their market exposure and lock in future oil prices, which is why they're often trading against the trend. Knowing this information can prepare you to make more informed trading decisions. Brent or WTI, what to trade? Brent crude and WTI are the two main benchmarks of the global oil market. Brent crude was first extracted in the North Sea and is heavier than WTI, making it more expensive to refine. Brent is also the main benchmark for European, African, and Middle Eastern countries. WTI is lighter than Brent and the dominant benchmark of North America. Brent crude is often considered a better indicator of the global oil market, even though WTI is sometimes more heavily traded, CL ticker on NYMEX. New technologies, such as fracking technology, can create certain price divergences between those two benchmarks. But, in the end, both benchmarks are perfectly fine for trading and highly liquid. Keep an eye on the long-term picture. As the main energy source of our global economy, the price of crude oil tends to follow the ebbs and flows of worldwide economic activity. To understand where the price of oil is heading, it's helpful to assess the current state of the economy. Is the global economy expanding or contracting? What does the yield curve look like? What is the current phase of the business cycle? Answers to those questions can provide you with a significant edge in the commodities markets. Diversify your oil trading. In addition to making directional bets in the oil market, you can also diversify your exposure to oil with the help of different asset classes. For example, investing some of your funds in oil companies or ETFs that track the energy sector can prove to be a smart decision to diversify your holdings. Some of the largest oil ETFs include the SPDR Energy Select Sector Fund, XLE, the VanEck Vectors Oil Services ETF, OIH, and the iShares US Energy ETF. Besides investing in ETFs, you can also gain indirect exposure to the oil market by trading currencies of oil-producing countries, such as the Canadian dollar and the Mexican peso. When does the oil market open? The Chicago Mercantile Exchange allows you to trade oil futures around the clock, 6 days a week, with a 60-minute break each day. If you choose to trade CFDs, which are an over-the-counter product and not traded on exchanges, oil can be traded Sunday through Friday, 21 hours a day with a 3-hour break. Tips for oil trading. Start small. Oil markets can be very volatile, which can lead to large losses, especially when trading on leverage and with large position sizes. If you're new to oil trading, start with smaller positions and add to them as you gain experience. Don't overtrade. Trading with too much leverage can quickly blow your account. Although leverage is extremely useful when combined with proper risk management practices, don't overtrade and don't chase the market. There will always be new trading opportunities around the corner. Follow correlated markets. All financial markets are connected to each other. By following correlated markets, like equities, stocks of large oil producers, commodity currencies, Canadian dollar, Mexican peso, Australian dollar, Russian ruble, the bonds, the yield curve can provide important clues about future economic prospects. You'll be well prepared as a commodity trader. Analyze OPEC meetings. The 13 OPEC countries hold regular meetings to discuss current conditions in the crude oil market and adjust supply if necessary. Oil can become extremely volatile around those meetings. Use technical analysis. Once you've identified the most probable direction for the oil price, it's time to add some technical analysis to the mix. Find important technical levels and place your stop loss and take profit orders around those levels.